Hello. Sorry about the delay. I had some technical problems on my computer, so now I'm going to be doing this from my phone. I hope you're all still there and tuned in. Um, and welcome back to the Inside the Market series. Uh, and there's an old saying, the market is a device for transferring money from impatient to the patient. And I'm sure over the last couple weeks, actually over the last couple months, you probably have experienced some times of being impatient, and maybe less so being patient. Uh, but it's really this whole series today is going to be talking about the psychology of trading, and I've mentioned this before. The psychology of trading is probably the most important thing when you're trading, because it's easy to not easy to trade, but when things are not stressful and it's not volatile and you're making a little bit of money, or maybe you're losing just a little bit, it's easy to stay calm. But when things start getting crazy and you see that number on your screen getting lower, and you're long and it doesn't work, then that's when the impatience starts to come up, and you make sometimes emotional decisions. And it's really hard to stay patient. How can we stay patient when we see others' assets multiplying while we're on the sidelines? And how do we keep, not want to say cool head, but how do you keep a neutral position so that you react to what's on your screen, and not necessarily what's in your head? And today I want to step away from the price charts and for a moment to discuss what truly drives this market. I've trained a lot of traders, not in crypto, certainly in equities in my career. And the the most important asset I told them was your mind, your ability to trade confidently and calmly on a day-to-day basis over a long period of time. And what happens is, if you get into a stressful situation, and you're overextended, and you make decisions that are you wouldn't normally make in a rational or a calm period, you can lose a lot of money. And losing money is painful, but the other hidden effect of that is, you're when you enter the market again, you're nervous, you have self-doubt, you're not quite sure of your trading strategy, you hesitate when you should be reacting, and this causes further problems. So you have two issues there. You have the loss of money, which is immediate, and then you have the psychological impact, which is can be quite powerful and damaging, because your ability to trade every day is going to determine, or frequently anyways, trading not necessarily daily, but frequently, is going to determine how much money you make in the long term, because trading involves risk. You can't hide from risk, but you can certainly mitigate the risk. And I want to sort of decode the loops, the psychological loops, of FOMO, fear of missing out, fear, and learn how to use real-time data to avoid, not necessarily to avoid falling into the traps, but certainly to mitigate a lot of the issues that come out of that. And the truth is, most losses don't come from lack of knowledge. It really comes from decisions made under emotional pressure, especially when the market is moving fast and it's going against you. So I've got a lot to share today. And again, I apologize for getting on late. And hopefully we'll be able to cover everything in our session here. But you have I want to jump right into it, and then we'll get into the Q&A after. But we have the emotional cycle. You have euphoria, then you have denial, then you have fear, then you have accumulation, and then you have recovery. And typically what happens is you start making money, you start feeling really good, um, and then it starts to turn against you. You say, well, I'm going to stick around. I'm going to see, and this is could be on the short side or the long side. Both are the same, except the short side tends to be more painful when you're wrong. But and then you're in denial, and then it starts to move further away from you. You start to be scared, you get fearful, and then you settle down, you pick up the pieces, and then you recover. So you know this is this is in any market, okay, not just crypto currencies, but also in commodities and stocks, and because these are humans, we're all human trading different markets, and the human reaction to markets tends to be similar, uh, across the world, not just here in Vietnam or US or Europe or China or wherever it may be, because we're humans first, and we react to the same, we don't like to lose. We get fearful of losing money. We get excited when we make money, and we become uncertain when our confidence is damaged. This is quite common, across many different, not only in trading but other endeavors as well. So, part of the way to avoid that, or at least to lessen the impact that has on you, is to have a trading discipline. And it's really easy to write down on paper and say, okay, this is going to be my trading discipline. I'm going to have pre-planned rules. I'm going to have stops, sell stops, buy stops, and avoid any kind of chasing. Well, that's all good until you get into battle, and all of a sudden it's like, well, maybe this time is different. And I will say to you, I've traded for many years. I will say to you that there actually is a time to break your trading rules, but you have to have a lot of experience in the markets when to do that. And if you do break the rule, it shouldn't be all in. It should be a small piece of your total investable assets. So, right now, I would assume most of you are learning how to trade, and I'm talking a number of years of trading where you start to have the intuitive sense that maybe this rule needs to be bent a little or changed, or the markets have changed, or geopolitical events have changed, and as a result, we are you're able to change a rule or to bend the rule. But today, let's focus on setting up your rules. And you know these rules um, uh, are put in place to take the emotion out of the trading. Uh, Buy stops, sell stops are pre-planned. They're set up. You enter a position. You say, okay, I'm going to set up a sell stop on the long side at 10% above my entry point, and I'm going to exit. Maybe you exit 100% of your position. Maybe you say 25%. Whatever the rules may be, you can program those into into the platform, and actually set up these trading rules to help you. The problem comes when you override all that and you say, well, I'm not gonna, I'm gonna ignore this. I'm not gonna follow this discipline because I feel something's different. And this is when you start entering into uh, you know the phase of possible psychological damage, meaning a dent in your confidence. Sometimes you'll do that and you make money. And I think this is probably the worst thing that can happen, because what that does is it gives you a foundation, or at least in your mind, a short-term foundation saying, well, I broke the rules, I set the rules, but I made a decision and I made money. Well, I can tell you that most times that decision will result in a loss, not in making money. But sometimes you may get lucky, and you may make money, and that reinforces the breaking of the discipline instead of sticking with it. So trading is about not trading the exception, but trading the rule. And what that means is I want to trade in high probability trades. I want to make trades that will work a significant number, a majority of the time, maybe 60% of the time, 70% of the time. That means that 30% they won't work, but a lot of people do it in reverse. They say, okay, this might work, and I may make a lot of money if I'm right. It has a low probability trade, you end up losing a lot of money. But again, you can point to people that did that and made a lot of money. So I think as a trader, you have to be a little bit more conservative and try to go with what you determine to be a high probability trade. Once in a while, you can take a flyer, with a small amount of money. Once you have more experience under your belt, and you want to use data. There are signals in the market, right? There are signals that data signals that will give you a slight edge. I'm going to say an edge, but it will give you more knowledge and a clearer picture of what's really happening currently. And I'm talking about funding rates. I'm talking about open interest. I'm talking about skew, implied volatility, and you may have heard some of these things to gauge sentiment. And open interest, as you may know, is obviously open interest on the derivatives and the futures markets on how much interest is there going forward. Are there more? Are there a lot of buyers? Are people accumulating calls? Are they accumulating puts? And that will give you an idea, um, where it's weighted. Now, the problem with that is that just because a lot of people are doing it doesn't necessarily mean that a guarantee that they're right. Um, and a lot of times, again, this is a more advanced trading strategy. As you become more experienced, you can try to fade or go against that crowd, right? And again, this is something that you'll have to learn over a much longer period of time. But to keep it simple, one of the data points, okay, there's of the trading universe, the open interest on calls, it looks like it's much higher than the puts. And so that means that can read in simple terms that most people believe that the market's going to be moving up, and the opposite is true on the put side. And in the this is similar to the skew and implied volatility, and so basically, if there's a big premium on calls and at similar expiration dates, and the puts are cheap, again, this is supporting the idea that there's a lot of interest in the call side, and so that difference is can be very big, very noticeable, and again, this could be many reasons why, but you're just trying to get these criteria lined up to say, okay, generally speaking, looking at this data, where does this bring me? It looks like the consensus in the market, at least in the trading universe, is that open interest is high in the calls. The premiums paid for calls are higher than the puts on the same expiration, and so, but if you just think about that, if you have more people buying calls, then the people who are selling those calls and trading those calls are, it's supply and demand, right? So they see the demand high, so the premium goes up, and the skew and the implied volatility becomes even higher. Um, and trading is nuanced. What I mean by that, trading is it's not black and white. It's not simple. If this happens, I do this. If this happens, I do this. There's always a gray area that's involved in trading, and that area needs to be, that gray area is where you learn the trade, you learn the craft of trading. And again, I spoke earlier about breaking rules, or when to break rules and when to be a little more flexible. Again, this is a learned trait, and it comes from a number of years of active trading. So I wouldn't do that now. I would just go with the flow, use this data, and say, okay, looking at all of my data points, it looks like this market is going to uh, move up. And you can also, see trend reversals with this too. So let's say that, the open interest, let's say open interest is falling, both in puts and calls. That would be, something that we wouldn't want to see, because that means it's sort of sitting in a tight trading range, right? And you want to see, the uh, other idea that you can look at is cumulative volume delta. That's basically the difference between buy volume and sell volume. Very similar, right? So at any time you have, this is able to measure, volume, buy volume and sell volume. So you can assume that if there's a lot of volume on the buy side and not so much on the sell side, that the prices will move up. But this has to also correspond with, it has to be a very large, obvious difference between the buy and sell. There's always going to be, the markets move every day. So ultimately, you have more buyers than sellers, the stock, or the crypto goes up. If you have less, it falls. And then also, this becomes really important on heavy volume days, right? So if you have big volume, bigger than average trading volume, and you're seeing a lot of buyers, this is something to pay attention to, right? And the opposite is true on the other side. So, and you've got to be able to um, think about, okay, you started a path, you're trading, and you have in your mind what's a long-term trend. Now, the long-term trend, maybe it's a year, maybe it's 2 years. I'm not sure. Everybody has different ideas on what long-term is and what short-term is. But that is sort of your goal. That's, and you can say, generally speaking, even though we've had a big pullback over the last 5 months or 4 months, the trend has definitely been up. Okay, over a longer period of time. If you look at a price chart, and the trend is it goes over. You have moments of volatility that are severe and very painful, but the trend still stays intact. And right now, it seems to be, the trading in the, low 60s to high 60s, somewhere in there, and on Bitcoin, and it looks like this is a trading range, and not quite sure whether this is going to break out or whether it's going to break down anymore. But you need to separate long-term goals, long-term trends with short-term noise, and there's a lot of short-term noise. I mean, you have people who are constantly throwing rumors in the market, trying to move the markets. And some of these are warranted, and some are just simply lies. Rumors to make things move. And so you've got to make sure that the information that you're getting on the short term is not, it's hygienic. It's you can verify the source. It's a respected source, because two things will happen. One, they have a high probability of being correct. But the other thing is that if a lot of people respect this opinion, then it's going to have a longer term impact on the market. It's not just going to be 10 minutes of volatility and then quiet down. So the less credible the source of your information is, the quicker the moves will be, and there are bumps in the road, up and down. But they are enough to be able to shake you out of a position. So you have to be in your own mind, say, okay, these are the sources I'm going to rely on, the sources of my information, and try to stick to those. You'll pay attention to the other rumors that come out, but try not to let it interfere with your long-term goal, because they have a really bad habit of being able to shake you out of what are really good positions. And it goes down, you're long, it's trending up, but it has an air pocket, you sell, and then it goes right back up, later in the day. And this isn't new to crypto. This existed in stocks. When the equities stock market in the U.S. first started, they had a lot of the big families, a lot of the big banks. I won't mention names, but a lot of the big investment banks were started by traders who were trading large sums of money, but they were doing what's called pump and dump, right? Pump and dump is basically, they throw out a news story, or they spread rumors. At that time, it didn't have the technology we have today, but at that time, back in the 20s and 30s, they had rumors, right? And these rumors would spread from one person to the other, and the stock would jump up, and then they would be sellers. The people who had started these rumors would be sellers into that buying frenzy, and then they would just laugh all the way to the bank. And again, I'm not going to mention names, but some of the biggest names in the world, their family wealth was created by these pump and dump schemes, right, in the U.S. And what happened was that the SEC, which is the regulating arm of the U.S. Equities markets, recognize this, and now there are huge penalties and actually jail time if you try to manipulate, if it's proven that you try to manipulate stock price. Right now we're in the beginnings of the early stages of crypto trading. It's been around for a while, and it keeps on evolving, and liquidity comes up. So we are in the phase where this kind of stuff can happen, and it's not really regulated, or there's no way of tracking it. They're working on it, and they're getting it, but you have to be aware of it. And the one way to do this is to protect your we only rely on the sources that you have researched and believe to be credible, and pay attention to the noise, but don't make big investment decisions based on non-verified news sources. And so, I mean, trading, a lot of people think that trading is simply a systematic, it deals with numbers. It doesn't. It does in a way, just because you have to pay attention to numbers, but you have to remember the people trading, the people behind algorithms, the people behind everything, they're all people, and they all have similar emotions to you, and behavioral patterns that you can recognize. So really, I think to be the best trader, or a consistent trader over time, and consistently make money over time, is to be more concerned with the psychology of the market rather than the numbers. The numbers can support whatever psychology you're seeing, whatever behavior you're seeing. Is there mass panic in the market? Is there a lot of greed? And so really, you as a trader have to determine, you know, what's more prevalent today, or in the short term. Is it greed or is it fear? And those are the two fears. Those are the two things that drive markets: greed and fear, right? Greed that, oh, I'm going to be missing out, and I need to buy, I need, or sell, whatever it may be, if you're on the short side. And fear is, I've got to get out of this because I'm losing money, and I'm going to sell it at any price. And every day there are degrees of both. Sometimes it's clearly one side, or the other. These are easy trading days, right? These are easy. The harder trading days become the days that you have to try to figure out when there's a little bit of greed, a little bit of fear, and it may not be across the board. It may be on a macro level. It might be on a regional level. But these are all considerations that have to come in. So I could talk for hours and hours about this, because I find it fascinating. And I think, if you are able to understand human emotions, it will actually make you a better trader. And the data points that we talked about earlier can support those conclusions that you make from the psychological side. But, because these numbers that you see on the screen, these turning points, the support levels, the ceilings, the resistance levels, the trading ranges are all driven by people like you. 100%. There's nobody else, right? Everybody is people are doing this. So you have to become an expert, or at least astute, in being able to determine where you are at any point in time, and try not to let it impact your short-term trading. So I just want to get to the questions. And I hope most of you are still with me now, because I know we've gone over our allotted time, but please stick with me. Question one: what are the most common behavioral signs that someone is trading under FOMO without realizing it? And again, FOMO is fear of missing out, right? So, um, and it's a sign that you're doing it, right? You have to ask yourself, why am I buying this stock or this crypto? Why am I buying that? Why am I trading now? Why am I going long at this particular time? Is it because I really see this trend, or is it because, well, I don't really see it, but I better jump on board because everybody is buying now, and I don't want to be left behind. I don't want to be sitting here saying, oh, I missed it. I missed the move. The beautiful thing about trading, okay, is that there's always another train coming through the station. You can always catch the next train. You don't have to, react because the crowd's reacting. If you're able to and take advantage of it, and you see it early enough, then okay. But do it with small percentages of your portfolio, right? Don't If you really are fearful, let's say you don't really feel that the market, your conclusion is you're not sure what's going to happen in the market. You don't feel really strongly about the move to the upside, but you don't want to miss out, right? Okay, fair enough. So what you do is you just take a small percentage of your available cash or assets, and take a small position. So, I've mentioned before that in trading, you also have to be comfortable with being half right and half wrong on a regular basis. You have to be okay. So let's say the market starts moving up. You go, oh, I've got to buy, buy, and you put a little bit in because you're not sure this is a trend or just a short-term move, and and it keeps on going, and it goes and goes and goes, and it goes, and it's a historical move. Okay, it's like, oh my God, I was right there, and I didn't pull the trigger, only bought a little bit. How stupid am I? But it could have just as easily gone the other way, right? So in that scenario, you were half right because you participated, but you didn't put a full all your assets into it. And let's say that it went up and then came right back down the next day or whatever it may be, and you only put a little bit in, then you you were wrong, but you were only wrong a little bit, right? And so your cautious, your conservative trading style actually helped you in that scenario. So it's a balance, and we've talked about this before, where You have to trade with your personality, whatever that may be. If you're more conservative, don't be making very large bets, all or nothing bets. If you're more aggressive, do it with smaller pieces. But certainly you need to stick with part of the psychology of trading is sticking with your who you are as a person, what your normal personality is. Again, and we covered this earlier in other talks, because when it comes down to extreme pressure, you will revert to whatever your person is. So if you were a person who's very conservative, but you were trading FOMO, and you jumped in, but you're not really comfortable with that, but you're still doing it because you don't want to miss out, and then the market turns a little bit, and you're dumping everything, right? Because it makes you nervous to be in. So this is one of the gauges of FOMO is are you comfortable in your position? Do you have reasons other than seeing other people being in the position to buy or short that position? And if so, then stick to your trading strategy. But FOMO can be deadly. And it's like musical chairs, right? When the music stops, there's only going to be a few chairs, and chances are, if you're trading FOMO, you won't get one of those chairs, and you're going to get hurt by losing some money in the downside, or a move to the upside. And then, you know, another question is, how do you decide position size when the market is moving fast so you don't overcommit emotionally? Um, and the answer to that, again, goes back to your person, right? So if the market's moving really fast, personally as a trader, when the market started moving, I like to participate a little bit, uh, and go along for the ride with a little bit, right? Up or down, whether it's short or long, whatever the trend happens to be at the particular time. And so, you know, typically, I think the safest way to enter the market in a market that is chaotic, you know, everybody's buying, 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 prices are moving up rapidly, asks keep on moving up, and the price goes, 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 goes. And you basically have missed the move. Okay. So, but you still want to participate. So what I would do is, I would do a small, just jump on board, do it any price, small piece, go for the ride. Okay. Typically, I had a saying in my trading, which was initiate when everything is quiet, and close my position when everything is chaotic. And so I would build a larger position when things were calm, and I could get decent pricing. There wasn't premiums on the buy side or on the sell side, and I could get good pricing. And then my sell strategy, or cover strategy, if I was short, was that when FOMO traders start jumping in and volatility picks up, then I am providing liquidity to the market. I'm selling into that, and I'm like, you can take it all. Here you go. It's going up. Take it all. And on the downside, it's like, okay, I'll cover down here, and I'll help it out a little bit. But so the way one of my rules, and this could be different for you, right? I'm not saying this is the way you should trade. I'm saying that you should, gauge it by how you are. But I think you should make the habit of initiating larger positions in calm markets, and exiting those positions when chaotic markets, or a lot of excitement up or down happens. And then if you've missed a move and it's already moving up significantly, participate, but participate in a much smaller piece than don't put everything in there. Just play with a little bit. You'll make a little bit of money, and maybe next time you will initiate in a calm period, and you can take more advantage of it. But the idea is to capture, bits and pieces of these moves, not 100% of the moves. So you don't have to worry about buying at the bottom, selling at the top, or selling at the top and buying at the bottom. You're trying to get the majority of the move, a large piece of the move, on a consistent basis over a long period of time. Uh, and then how do you personally decide, this is a good question, whether a move is still a valid trend or already the later stage hype part of the cycle? Um, this is going right back to what you just talked about. Uh, you don't. I mean, it's very hard to see that. But one of the big things is volume. Okay, if volume increases and it's predominantly to one side or the other, as long as volume stays up above the average, then typically that move will continue. But if you're starting to see significant decrease in volume in the current trend, whatever direction it may be going, I would consider that a warning sign because it's having fewer and fewer participants. The initial volume, let's just say you're long, the initial volume may have been simply short covering. It could be, funds getting out of their positions, whatever it may be, but it's not, it's a volume spike and then it dies down, then that trend will have a very difficult time to keep on going. So I would keep a close eye on volume and use that as a key measuring point, because without volume, either up or down, it's not going to go very far away from the mean or where it's trading right now. Um, and this is assuming that you're trading, currencies that are have large liquidity and don't have big spreads. If there's bigger spreads and there's not so much trading volume in those individual currencies, then you are subject to really violent price movement just with a little bit of volume. So I'm talking about on liquid assets that you're trading. Um, in question number 5, it says, when volatility spikes, do you change strategy or only reduce size and tighten rules? Um, yeah, I think you don't necessarily change strategy, but again, um, if 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 the boat is really bumpy and you're not comfortable being in that position, you're not comfortable, you don't have the personality to weather those bumps to get to the long-term goal, then I would definitely keep my size smaller. And the rules are going to be the same. Your rules actually should be the same. They shouldn't they shouldn't change in a volatile market versus a calm market. So I think you need to uh, adjust according to who you are as a person and on your size, but your rules should stay the same. Your rules are your rules, irrespective. In fact, the rules become more valuable in a volatile market than in a calm market, because those rules will be tested, and your commitment to those rules and your discipline will be tested. And in a calm market, they're not going to be. They sit there and nothing moves, and so none of your stops are hit, none of your you're just sort of in a neutral position. But certainly in the volatile markets, the rules should not change, but I think your size should. So if you're uncomfortable with the volatility, I would just keep very small size, because you want to be a participant just in case. And if it's wrong, if you participate and you lose money, you only lose a little bit. It's okay, not a big deal. You can keep your core trading safe, and continue focusing on your long-term goals, whatever that may be, or what you're perceiving to be long-term trends. And I want to, before we wrap up, because I think we've gone a little bit of time here, but before we wrap up, I want to leave you with one final thought. And the crypto market may change by the second, and trends may come and go, but human psychology remains constant. And again, this never changes. Over thousands of years, it hasn't changed. Everybody, fear and greed are, if you look at any time in human history, have always been around, and have driven macro political, geopolitical events, wars, you name it. So that doesn't disappear, and that should be that should be the foundation from which you build your trading strategy, and use the data points and different criteria and different tells, that support or dismiss or diminish your position on the psychological side. So you need to, number one, get used to trading from a psychological standpoint and get that foundation in place, and then support that with data points. And there's lots of different ways to do that. And I'm constantly looking for different criteria to measure that by. But again, my core trading is always about fear and greed. What's more prevalent today, and don't let the red and green candles on the charts, dictate your wallet. You have to build a strong immune system as an investor by, combining your personal discipline with the real-time data. And then this is how you learn. And it is doable and it is achievable. But most people try to only attack the markets from one side, and that's a data-driven side. And I would say that in the equation, of a successful trade, I would say that 75% of the success comes from the psychological component, and 25% comes from the data, because the data points are important. They're showing, on a large scale what people are doing, and they may be just trading from FOMO. Who knows why they're doing it? It just shows you that they are doing it. And then it's going to be up to you to determine from the psychological side whether this is something you should be a contrarian on, or whether you should jump on the bandwagon. And this is, not an easy thing to do, but it can be learned through time, experience, and observation. So I thank you for being here, and I appreciate your time and your attention. Uh, I wish you a sustainable and courageous investment journey ahead. And again, I apologize for coming on late. Um, you know, we'll try to make up for that on our next talk. So, good trading ahead, and I'll see you in about 2 weeks. Thank you.